Hello viewers, welcome to my channel. I'm Hashim Ali Khan. So in this video I'm going to explain you the deductions from gross income from salary. So in the earlier videos I have explained you the complete procedure of how to compute the income from salary. 4 elements are there. The first, salary. Second, allowances. Third, perquisites. Fourth, profit in lieu of salary. The total of these 4 is called gross income from salary. From gross income from salary, 3 deductions are available under section 16. So in this video, I'm going to explain you those deductions. After deducting those 3 deductions, we'll get the final income from salary. So this video is related to the earlier videos. So my suggestion to the regular viewers, genuine students who want to get a complete command on this subject of income tax, to watch the earlier videos. So if you have not watched, if you have joined right now, it will be difficult for you to understand. So keep a rhythm, keep continuity of watching all the videos, then only you can get the command. If you have not watched, I suggest you to go to the playlist of my channel, select the subject Income Tax 1 for the assessment year 2021. Select the video Income from Salary. Watch the video continuously, then only you can be able to come to this point of deductions from income from salary. Now we'll start our theory class today. Deductions from salary. So 3 deductions are allowed from gross income from salary. The 3 deductions are standard deduction under section 16(1)(a), then EA deduction, entertainment allowance deduction under section 16(2), and profession tax or employment tax under section 16(3). So only 3 deductions are available from gross income from salary. The first, standard deduction under section 16(1)(a). This standard deduction is a compulsory deduction whichever SSC has income from salary. All the SSCs who are having income from salary, compulsory deduction will be given standard deduction. That's why this deduction is called statutory deduction. This standard deduction will be allowed for meeting all incidental expenses relating to employment. Relating to employment, a number of incidental expenses like going from house to the place of work, coming back, or stationary expenditure, petrol expenditure, medical expense, so many expenses the employee will incur in relation to his employment. So without considering the actual expenditure incurred, a statutory deduction will be given by the Income Tax Act. The statutory deduction is gross income from salary or fixed amount of 50,000. This 50,000 is given by the Income Tax Act, ceiling amount. The gross income from salary or 50,000, whichever is lower, least, that will be allowed as deduction under section 16(1)(a). Compulsory deduction for everybody, whoever is having income from salary. Next comes EA deduction. This EA deduction theory already I explained the beginning, video. When I have explained you about allowances, entertainment allowance, I explained to you in detail. So EA deduction under section 16(2) will be allowed only if a person is having entertainment allowance and also he is a government employee. He is a government employee. So 2 conditions. First of all, the SSC must get EA, entertainment allowance. Secondly, the SSC should be a government employee. Then only deduction will be allowed under section 16(2). Under section 16(2), only government employees will get the deduction. Deduction is list of the following 2 amounts: 20% of salary, actual year received, or fixed amount of rupees 5,000. Whichever is least among these 3 will be allowed as deduction. Non-government employees will not get EA deduction under section 16(2). So for getting this deduction, first you have to see whether it is a government employee or not. If government employee, this deduction. And salary means only basic, only and only basic, no DA, nothing, no other thing should be included, only basic. That's all. Now profession tax or employment tax. If an SSC has paid professional tax or employment tax, he will get deduction under section 16(3). Actual amount paid as professional tax will be allowed. If the amount is due, not paid, it will not be allowed as deduction. So these are the three deductions which are allowed from gross income from salary. After deducting these three, we'll get income from salary. That's it. Now I am giving you a format how to find out the income from salary. What is the procedure format of computing income from salary? The format of computation of income from salary, computation of Mr. Dash income from salary for the assessment year. The first salary. This is only a brief example, illustration of the format. Many other items may come, but broadly these are the normal items you will find in the computation of income from salary. The first salary. Under salary, basic, bonus, fees, commission, employer's contribution to RPF. In the next session, I will explain you what you mean by RPF. In excess of 12% of salary. And excess of interest from RPF over exempted rate of 9.5%. Then allowances, dearness allowance, dearness pay, CCA, HRA, EA. These are the examples. Apart from that, many other allowances may come. So after allowances, perquisites. Rent-free accommodation, insurance premium paid by employer, provision for domestic servant. These are the perquisites. Profit in lieu of salary, compensation received on termination, transferred balance from URPF to RPF, will get gross income from salary. The four items, basic, allowances, perquisites, profit in lieu of salary. The total is gross income from salary. From these deductions under section 16, standard action 16(1)(a), year deduction 16(2), profession tax 16(3). Deduct it, you will get income from salary. That's it. Now we will discuss the last topic in this income from salary. And this topic is Provident Fund. After completing this topic, we'll start the final problems on computation of income from salary. Right? So theoretical part will be completed in this video. Now, first of all, Provident Fund. What is this Provident Fund and what is the treatment, tax treatment for Provident Fund? To promote the social security through savings, the government has framed a scheme called Provident Fund scheme. Now, generally what will happen? A person who is employed, he will earn an income up to the age of retirement. After retirement, the income ceases to exist. He will not get income from salary. He will get, sometimes he will get meager pension, or many times he will not get even pension also. That means there will be no financial security after retirement. And the people and the employees normally will not save, will not think about future. So government, in order to provide social security through savings, the government has framed a scheme, and that scheme is called Provident Fund scheme. What is the features of this scheme? When scheme is employed, Provident Fund scheme is employed, what are the features? The first feature, the employee contributes a fixed percentage on basic pay or basic pay plus DA. The first feature is, from his monthly income, a certain percentage of basic salary or basic plus DA will be contributed in the Provident Fund scheme. It's compulsory. The government made it compulsory that when an employee is working in an organization, every month from his salary, a certain percentage will be deducted and deposited in Provident Fund department, Provident Fund scheme. Suppose an employee's monthly salary is 20,000. Monthly salary is 20,000. So government has framed a scheme that 5% you have to deposit. So 20,000, 5% is 1,000. So out of 20,000, 1,000 rupees will be deducted from his salary. He will be paid only 19,000. That 1,000 rupees the employer will deduct and deposit that 1,000 rupees in Provident Fund scheme. So every month 1,000 rupees are deposited. So in 1 year 12,000 rupees are deposited from his salary. He is saving. He is saving in the Provident Fund scheme compulsorily, because it is the scheme framed by the government. It is not voluntary, it's a compulsory one. First one. Second one, the employer contribute the same amount or higher or lower amount. So according to the scheme, the second feature is the employer must also contribute from his pocket into the scheme of the employee. Mr. X is the employee. Every month his salary 20,000. Out of 20,000, 1,000 rupees are deducted and deposited in Provident Fund scheme. 19,000 will be paid. Along with that, employer will also contribute the same amount or higher amount or a lower amount. So let it be same amount. 1000 rupees are deducted from the employee's salary and deposited. Same 1000 rupees will be deposited by employer in the account of employee. So monthly 2000 rupees are deposited in Provident Fund scheme. 1000 are deposited by the employee himself and 1000 rupees will be deposited by the employer in the account of the employee. That's a benefit to the employee. Because in employee's account, employer is also contributing. So employer contributes an equal amount or higher or lower. Then when the employee retires, he will be paid back his contribution, employer's contribution along with interest on both. So what is the last feature? Continuously, as long as he is working, as long as he is in service, every month some amount is deposited in the Provident Fund. Employer also contributes some amount. On this total amount, interest will be credited by the Provident Fund scheme. Interest will be credited on the employee's contribution, on the employer's contribution. On both contribution, interest will be credited. And the whole amount will be paid to the employee at the time of retirement. These are the features. So briefly, every month some amount will be contributed by employee, some amount will be contributed by the employer, and this amount will get accumulated and this amount will be repaid to the employee at the time of retirement along with interest on both. That is the feature. Now, taxability. Which one is taxable? Employer's contribution to Provident Fund. Employer's contribution to Provident Fund, it's an income. It's an income in the hands of the employee. Now X is depositing from his income and also employer is also contributing. So whatever employer contributes in the account of employee's PF, for employee it is an income. Unexempted amount is taxable. Now we will see what is unexempted amount. If it is exempted, nothing is taxable. If it is unexempted, the unexempted amount is taxable in the hands of the employee. Which one? Employer's contribution. Employer's contribution. Then employee's contribution to PF. It's a saving. And if it qualified, then deduction under section 80C. See, whatever employee is contributing, that is his savings. Every month his salary income is 20,000, but he's not getting 20,000. Employer is paying only 19,000 to him. 1,000 rupees employer is depositing in PF. So whatever 1,000 rupees deposited in PF, that is saving of the employee. Now if it is a qualified saving under section 80C, in the coming videos I'll explain you about deductions from GTI. Deductions from gross total income. In those deductions, one deduction is deduction under section 80C. And one of the item which qualifies for deduction under section 80C is contribution to PF. Employees' contribution to Provident Fund. It will qualify for deduction under section 80C. Last one, interest credited in PF. Whatever interest is credited in the Provident Fund account, that is an income in the hands of the employee. If it is unexempted, it will be taxable. If it is exempted, nothing is taxable. So when it is exempted, when it is not exempted, I'll explain you further. But right now remember, what is the taxability? Employer's contribution to PF. It is an income in the hands of employee. So if it is unexempted, it will be taxable. Unexempted amount will be taxable. Employee's contribution to Provident Fund, it's a saving. If it is qualified saving, then deduction employee will get under section 80C. Interest credited in Provident Fund, it's an income in the hands of the employee. If it is unexempted, that will be taxed. These are the taxable provisions. Now, kinds of Provident Fund. Income Tax Act has divided Provident Funds into 4 categories. That is Statutory Provident Fund, SPF, Recognized Provident Fund, RPF, Unrecognized Provident Fund, URPF, Public Provident Fund, PF. So simply we can say SPF, RPF, URPF, PPF. Shortly, we can say like this. Now, each of these provident fund will have different features regarding the taxability. So you have to remember this. If you watch with full concentration, you don't find any difficulty while solving the problem. You must be clear in mind regarding what is the tax treatment for different provident funds. First, SPF, Statutory Provident Fund. This Statutory Provident Fund will be applied only in case of government employees. In case of central government employees, state government employees, local authorities, universities, or recognized educational institutions. Remember, this SPF will not be applied in every organization. Statutory Provident Fund will be applied in central government departments, state government departments, local authorities, universities, or recognized educational institutions. Only in this organization, SPF will be applied. What are the features now? Employer's contribution. Employer's contribution to SPF, it is fully exempted from tax. Remember this point, very much important. Employer's contribution to SPF, Statutory Provident Fund, fully exempted, not at all taxable in the hands of the employee. Right? For example, Mr. X is working in central government department. Every month, employer contributes in his SPF, Statutory Provident Fund. Income Tax Act says nothing is taxable because you are working in a government department where SPF is employed. Employee's contribution. Now, employee's contribution fully qualifies for deduction under Section 80C. Whatever employee contribute to SPF, that will fully qualify for deduction under Section 80C. Interest. Interest credited in SPF is fully tax-free. Completely tax-free. No income tax will be applied on interest credited in SPF. So these 3 points you have to remember. Employer's contribution to SPF fully exempted from tax. Employee's contribution to SPF qualifies for deduction under Section 80C. Interest credited in SPF completely tax-free, exempted. That's it. These 3 points you have to remember for SPF. Now RPF, Recognized Provident Fund. A provident fund which is recognized by CIT, Commissioner of Income Tax. If Provident Fund is recognized by Commissioner of Income Tax, it will be called RPF. So where this RPF will be applied, it is applied meant for business establishment in public and private sector. In public sector and private sector organizations. Public sector and private sector organizations, RPF will be applied. So this is the most commonly adopted Provident Fund. Most commonly adopted Provident Fund is RPF. Now, employer's contribution. Up to 12% of salary is exempted and the remaining amount is taxable under salary. Very much important. Remember now. So, employer's contribution to RPF. Income Tax Act says if the contribution is up to 12% of salary, then it is not taxable. It is exempted. If the employer contributes more than 12% of salary, the excess amount is taxable under the head salary of the employee. Salary of the employee. Simple example I'll give you. Suppose Mr. X is working in ABC company, in which RPF is applied. His annual salary is 1 lakh. Annual salary is 1 lakh. Suppose. So, employer contributes 15,000 rupees in his RPF. Employer contributes. Income Tax Act says up to 12% is exempted. So 1 lakh rupees, 12%, 12,000. So up to 12,000 rupees contribution is exempted. Over 12,000 contribution is taxable. Actual contribution 15,000. 12%, 12,000. So 15,000 minus 12,000, 3,000 rupees employer's contribution to RPF is taxable under their salary. Right? This is the provision regarding employer's contribution. So simply remember, up to 12% of salary not taxable, over 12% of salary it is taxable in case of RPF. Now, employees' contribution. Employees' contribution fully qualifies for deduction under section 80C. Both same, SPF as well as RPF. Both will qualify for deduction under section 80C, employees' contribution. Now, interest credited in RPF. Now, Income Tax Act says exempt up to 9.5%. The excess interest credited over 9.5% is taxable under that salary. So, Income Tax Act says interest credited in RPF up to 9%, 9.5% rate. Up to 9.5% rate is exempted. If the interest is credited more than 9.5%, the excess will be taxable under that salary. So these are the provisions regarding RPF, Recognized Provident Fund. So I have explained you SPF as well as RPF. Now URPF, Unrecognized Provident Fund. A provident fund which is not recognized by the CIT, Commissioner of Income Tax, that is called unrecognized PF. Normally this unrecognized PF will be applied in case of private organizations, private establishments. They may apply unrecognized provident fund. Very rare provident fund. Most commonly found provident fund is RPF. Very rarely found provident fund is URPF. Now, a PF which is not recognized by CIT, this may be operating private. Employer's contribution, it should be ignored. When in the problem it is given the employer contributes to URPF, that means we should ignore now. Ignore does not mean that it is tax free. It is taxable. When it is taxable, when the amount is refunded at the time of retirement. Suppose Mr. X is working in a private company where URPF is applied. Every month the employer contributes 1000 rupees in his URPF. Income Tax Act says whatever employer contributes should not be considered. Ignore it. Ignoring does not mean that in employer's contribution to URPF is exempted. Not exempted. That amount when refunded after retirement, then it will become taxable. A huge taxable amount. For example, at the time of retirement, Mr. X is getting the refund from URPF 10 lakh rupees. Now on that 10 lakh rupees, income tax will be applied. Whereas refund from RPF and SPF, it is completely exempted. When a person at the time of retirement is getting the refund from SPF and RPF, not at all taxable. But in case of URPF, it is fully taxable at the time of retirement. Then employees' contribution. Employees' contribution does not qualify for deduction under section 80C. Remember, SPF fully qualifies for deduction under section 80C. RPF fully qualifies for deduction under section 80C. Whereas URPF, employees' contribution to URPF does not qualify for deduction under section 80C. Now, interest credited in URPF. Interest credited in URPF should be ignored right now. Ignoring again does not mean that it is tax free. It is taxable. The interest is taxable at the time of retirement. When the employee gets the refund from URPF, the employer's contribution and the interest credited in URPF both will become taxable at the time of retirement. So these are the features for URPF. Last is PPF, Public Provident Fund. PPF. This Public Provident Fund is open to everybody. Anyone can open an account with PPF, Public Provident Fund. So SBI, State Bank of India or its subsidiaries or authorized national banks or specified branches or post offices operate the scheme. This PPF scheme will be operated by State Bank of India, its subsidiaries or specified nationalized banks or post offices. So these departments, these organizations will maintain PPF, will operate PPF. Anybody can go and open the account in PPF, Public Provident Fund. So membership is open to all. Even if a person is an employee where RPF or SPF is applied, still he can open an account with the PPF. There is no bar on him. Suppose I am already working in a central government department where SPF is applied. Every month I am contributing to SPF. Apart from that, I have opened an account with PPF also. I can open an account with PPF. PPF account can be opened in my name myself or in the name of my spouse or minor children. Now, employer's contribution. Normally, employer will not contribute in PPF because PPF is a general provident fund. No employer will come and deposit the amount in PPF. But rarely, if the employer contributes in PPF, then it will become a perquisite. It will become a perquisite in the hands of the employee. It is taxable under that perquisites. Next one is employee's contribution. Employee's contribution to PPF will qualify for deduction under section 80C. 80C. But the minimum amount is 500 rupees and the maximum amount qualified for deduction is 1,50,000. Then interest on PPF, Public Provident Fund, completely tax free. PPF contribution completely tax free interest. Note, an individual's contribution may be in his own name or in the name of spouse or on behalf of a minor child. That means PPF account can be opened in the name of the person himself or in the name of spouse or in the name of minor child. So these are the complete provisions regarding theoretical part of income from salary. So Income Tax Act has given how to compute the total income of a person. The total income of a person may be income from salary, income from house property, profits and gains of business and profession, capital gain, income from other sources. So one by one we are going to study. So far in the last so many videos I have explained all the provisions regarding computation of income from salary. Theoretical part is over. In the next video I'll start the problems on computation of income from salary. Comprehensive problem where we will get all the provisions of salary, allowances, perquisite, profit of salary, deductions, everything will come in one problem. Those problems will do it in the next. Again, I suggest my regular viewers, genuine viewers who want to get a complete command on the subject to watch the video from beginning till end. Don't skip in between. And in continuity, if you watch, then only you can be able to understand, enjoy the subject income tax. Many students will feel that this subject is very, very difficult compared to other accounts, statistics or other subjects. This subject is very, very difficult. No doubt. If you take interest, if you enjoy learning the provisions of Income Tax Act, then definitely it's a very enjoyable subject. So don't make it a panic that so many provisions we have to remember. No. If you take the interest with full concentration, with full focus, if you watch the video, definitely it won't be a panic. You can enjoy the learning. Okay, so if you are satisfied with my lecture, give a like to the video, share it in your group, in your friend circles, give the feedback about my lecture, and lastly, don't forget to subscribe my channel. We'll continue the problems in the next video on income from salary.